Good afternoon and welcome to the session on break-even analysis. We are into 19th lecture, and if you remember, in last two classes we had discussed various aspects of sensitivity analysis. We discussed different cases, for example, cases involving single alternative, cases involving multiple alternatives, and then within these cases we had a number of situations such as one variable change at a time, two variable changes at a time, and more than two variables changes at a time. If you remember the previous lectures, as far as sensitivity analysis is concerned, we were primarily focused on finding the impact of changes in different variables over our decisions. So, our questions that we were trying to answer was, what will happen if I change this variable by more than plus 10% or more than minus 10%. So, these kind of questions we were trying to answer. Now, in current lecture we are going to discuss about break-even analysis. It is also another form of sensitivity analysis. The difference here is that we are more focused in finding the point at which the reversal of decision takes place. So, just try to understand the difference. In sensitivity analysis, we were trying to find the impact of changes in variables on our decision. We were not concerned about at what point my reversal of decision takes place. Break-even analysis just tries to answer that. It will tell you at what point your decision is going to change from maybe acceptance to rejection. If you try to see different forms of break-even analysis, this type of analysis is going to give you the answer between choosing the option of making a particular product or buying it. That kind of problem is known as make or buy, make or purchase. Then similarly, in construction industry, if you see the application of break-even analysis, you will find that such analysis is performed to find out whether it is advantageous for us to lease a particular piece of equipment, to hire a piece of equipment, or to buy it. So, that is why break-even analysis is a very important form of economic analysis. If you see the opening slide, it is very clearly written, it is another way of performing sensitivity analysis. And as we discussed just now, here we are more concerned about finding the value, which is also known as break-even point, at which the reversal of decision takes place. When you talk of reversal of decision, means you can either go for a particular decision or you can reject it. So, that is what we are calling the reversal of decision. Now, if you look back and try to compare it with the sensitivity analysis, we were not giving more emphasis or much emphasis on finding this break-even value. We were more concerned about finding the impact of changes in variable on our decisions. We were trying to answer the questions such as, what will happen to the project if the billing declines or costs increase or something else happens. These were our primary areas of concern in sensitivity analysis, whereas now we are trying to locate that particular point. We are trying to locate that particular point at which my decision is changed from one extreme to other extreme, from yes to no, from no to yes. So, at what point this decision reversal takes place is the primary focus of break-even analysis. So, we will try to answer, say for example, let us take the case of a ready mix concrete company or RMC company. Now, you will find that ready mix concrete company, when it works, naturally it has some direct cost, it has some indirect cost of producing, let us say, 1 cubic meter of concrete. Now, at this point I would like you to understand the difference between direct cost and indirect cost. In manufacturing industries, these are known as fixed cost and variable cost. So, manufacturing fixed and variable are more common. In construction industry, direct cost and indirect costs are more common. Now, going back to the example of ready mix concrete production, I said that there are two kinds of costs involved. One is called direct cost, another one is indirect cost. Now, what is this direct cost? Direct cost you incur only when your production is in progress. So, it more or less is proportional to the production that you are undertaking. Say for example, you are producing 10 units of concrete or 10 cubic meter of concrete, you may be incurring X amount of cost. If you are producing 15 units of concrete, you may be incurring maybe X plus some money as cost. So, these are known as direct cost, one which can be directly attributable to the production is known as direct cost. Whereas, if you look at the indirect cost, these are fixed, no matter whether you are producing or not, they are bound to be there. For example, let us say even if there is no production, the RMC company may have to pay towards rent, land charges, they may have kept certain number of staff to man the RMC operation, they may have certain security people, they may have electricity bill for lighting and other purposes, air conditioners. So, even if there is no production, you will find that the company will be incurring certain cost. These costs we call it as indirect cost. Now, in addition to these costs, we have number of other costs such as overhead costs, but all such costs we can try to bring them either in direct cost head or indirect cost head. So, sometimes it becomes very confusing as to what is direct cost and what is indirect cost. So, the basic idea behind these two costs is, if you find that a particular cost is going towards production of a particular item, that you keep it as direct cost, and those costs which you are not able to distinguish where exactly it is going, whether it is going for concrete production or whether it is going for some other material production, if you are not sure, then that cost we keep it under indirect cost. We will not be discussing direct cost as well as indirect cost in more detail, because this is covered in some other courses which you will be told. But for the time being, just understand that direct costs are those costs which can be easily identifiable with the production of a particular type. For example, if we are producing M20 grade of concrete, we may be purchasing aggregates, coarse aggregate, fine aggregate, we may be purchasing cement, we may be purchasing certain admixtures. So, whatever cost we are incurring, all these are direct costs. Now, as and when the production increases, you will find your cost towards them also increases, whereas indirect costs are those costs which are more or less fixed, such as rent of the premises that the company might have hired, the equipment that the company might have taken on hire. Now, irrespective of the production quantity, these costs are to be borne by the company, and that is why we are telling that these are more or less fixed, independent of the production value, production quantity. Now, these terminologies are better known as fixed cost and variable costs in manufacturing industry. Since more of these terms are used, so you will find that almost all the textbooks are using the notations of fixed cost and variable cost. Fixed cost they represent by F and variable cost they represent by V. But since this particular course has been designed for construction industry people, we are going to adopt direct cost and indirect cost notations in our problems, which we are going to solve little later. Now, we will look further into this break-even analysis. As I told you, we are here more interested in finding the point at which our reversal of decision takes place, and that point we are calling break-even point. Now, if I give you an example of a manufacturing industry, say there is some automobile industry which is producing car. Now, suppose that automobile company has got certain fixed cost irrespective of the number of cars produced, and there are certain variable costs which is measured per unit of car produced, right. So, these two costs when we combine, we call them as total cost. So, total cost would be nothing but fixed cost for a particular period plus the variable cost multiplied by number of cars produced during that particular period. So, if you try to write a formula, it would be total cost is equal to F plus V multiplied by N, where F is your fixed cost, V is your variable cost, and N is the number of units produced. Now, suppose the company has kept a price of P per unit. So, what would be the revenue if he sells N unit of cars? It would be N multiplied by P. If P is the sales price per unit and N is the number of units sold, the company is making a revenue of N multiplied by P. Now, at break-even point, we assume that the company is neither making any profit nor making any losses. So, we equate the two expressions. Revenue is equal to total cost. If you denote revenue with R, R is nothing but equal to fixed cost F plus N multiplied by P. This I will show you in form of slide also, right. So, that we will see little later. Now, in some textbook, break-even analysis is also referred to as cost volume profit analysis. If you look at the slide please, it is also known as cost volume profit analysis. If you just see the last line, it says the break-even analysis is also referred to as cost volume profit analysis. So, here basically we are concerned with finding that particular volume at which company is neither making any profit nor making any losses, and we are also interested in knowing that up to what value of volume, if produced, we will be getting some money out of this particular business. So, that is why it is known as cost volume profit analysis. Now, if you see the application of break-even analysis, its prime area of application is to analyze making versus buying a product, whether the company should make a particular product or whether they should buy it. Similarly, the other application area is if you try to look in, as far as construction company is concerned, whether to own a particular equipment or rent it. So, basically this particular analysis will tell you for what volume of something it is advantageous to buy the particular piece of equipment, for what volume of production it is advantageous to rent a particular piece of equipment. We will see one small example, it will be more clearer then. Fine. These definitions already we have discussed. What is fixed cost, what is variable cost, what is price. Price is what you realize after selling the particular product, right. Okay, these things we have already covered. Now, we will straight away move to a example in which I have assumed that, you can please note it down this problem, in which I assume that there is a ready mix concrete company which wants to find out the minimum production of concrete, which will just be able to recover its total cost incurred in a particular month. What we will do, first we will derive certain basic formulas and then we will give you certain numerical values which we can apply and then we can get the results. So, through this particular slide I am trying to find out or derive certain formulas. So, for deriving this set of formula, what I am assuming is, I am assuming the total cost as TC, I am assuming the indirect cost as IC, and direct cost I am assuming it to be DC. So, by definition that we have just now given, total cost is nothing but the sum of indirect cost plus direct cost. So, it becomes IC plus DC, that is total cost is nothing but the sum of indirect cost plus direct cost. Now, next what we do? Now, we further assume that the sales price that has been fixed by the supplier RMC manufacturer is P per unit concrete sold. That means, he is selling 1 unit of concrete at price P. So, if he sells n unit of concrete, the total money that he receives or that the company receives becomes n times P, right, and this is what we are calling as revenue. So, revenue becomes n times P. Now, what would be the gross profit? Suppose you know how much money you have received for selling n unit of concrete and how much costs you have incurred for producing n units of concrete. So, difference is your profit. So, that we are denoting as Z, and that would be defined as revenue minus total cost. So, Z becomes equal to R minus TC. Now, R is nothing but NP and TC is nothing but IC plus N times DC. So, effectively what we are getting as Z is equal to N times P minus DC minus IC, right. If you see how it has been worked out, it is very simple. I am assuming that my total cost is sum of indirect cost plus direct cost, which is nothing but direct cost is N multiplied by how much? No, TC is I plus N times DC. Total cost is sum of indirect cost plus direct cost, right. And finally, what you see is, just a moment, suppose the company is selling n units of product, so the total direct cost. Now, his revenue would be R is equal to N times P. Now, the total profit I am defining as total cost minus, revenue minus total cost, which is nothing but N times P minus IC minus N times DC. There may be slight confusion if you see the top line, it says total cost is equal to indirect cost plus, you can say total direct cost, TDC you can assume. Now, total direct cost will be nothing but N times DC, direct cost for 1 unit production. So, the total direct cost becomes N times DC. So, this is as far as my total profit is concerned. This I can write it like N times P minus DC minus IC. So, this is my total profit. Now, if let us say there is a tax implication and we are paying T tax on this profit Z, so the net profit would be given by Z dash I am denoting as net profit, and this would be equal to Z multiplied by 1 minus T, where T is the tax rate. If let us say tax rate is 40%, so T becomes 0.4. If let us say T is equal to 0.4, Z dash becomes Z into 1 minus 0.4, that is 0.6 Z, 0.4 or 40%. Now, what we do next? We define break-even point as that particular point at which I am just able to recover my costs. So, that means at break-even point my total costs are equal to my revenue. So, that means whatever I have incurred, I am able to get it back by selling them. That means I can equate Z equal to, what is that? Rather, I would equate total cost TC and the revenue. So, I will do R is equal to total cost. This is at break even point. Now, my R value is nothing but N times P, and TC is nothing but N into DC plus IC. Now, remember that this is true only at break even point. That means, at break even point I am just able to recover my costs. So, whatever I have spent, I am able to get it by selling that particular product. Now, anything less than this value of N, that means I am running into losses. This you have to very clearly understand. Anything less than the break even point means the company is making losses, and if the company is able to surpass this, that means if the company is able to produce more than this, the company is making profit. So, this is what is represented like this. We can write it like this. This implies P minus DC times N is equal to IC. This implies N is equal to IC upon P minus DC. Now, this particular term P minus DC is also known as contribution. Now, at break even point, N becomes B. So, we have break even point as B equal to IC divided by P minus DC. The break even production, we define it as B, we denote them by B. So, that is why I have written N as B, and we are telling that this is the break even production level, and below this value of B, if the company is producing, that means company is making losses, whereas if N is greater than B, company is making profit. If N is less than B, company is producing losses. If N is exactly equal to B, the company is neither making any profit nor making any loss. Now, the result of break-even analysis is often shown in the form of a chart, and that kind of chart we call it as a break-even chart. So, naturally the chart would contain a direct cost line, an indirect cost line, and a total cost line. Besides these three lines, we will have a line which will show the revenue line. Now, one such example of break-even chart I will show you right now. This is already plotted here. You can notice this is one of the break-even charts which most of the times are used to show the results of break-even analysis. Now, in this, on your x axis you find the production or the quantity. This could be in cubic meter, this could be in a square meter, this could be in number, the unit could be anything. And on y axis we show cost. So, what you see is that there are 4 lines which are there in this particular chart. One line is corresponding to direct cost, another line is corresponding to indirect cost, third line corresponds to total cost, and finally there is one more line which is corresponding to revenue. Now, one thing you might have noticed by now, that all these computations, whatever we are doing, we are assuming a linear relationship. So, this type of analysis is also sometimes known as linear break-even analysis. Why? Because we are assuming that it follows a straight line. For example, when we plotted this indirect cost, it is just as a straight line because the costs are fixed. It is a horizontal line, right? Then if you try to plot the direct cost, it is again in the form of a line. If you try to plot it here, it will look something like this. On x axis I have got quantity, let us say this is n, here I am having costs. Now, first I draw the indirect cost line. Indirect cost is fixed, that is how we defined it. It does not depend on the number of units produced. So, you will find that it will be of this form. It will be like this. So, this is corresponding to my indirect cost IC. Now, I will try to plot the direct cost line. Now, if I am not producing anything, my cost would be 0. If I am producing 1 unit, my cost would be x. If I am producing 2 units, my cost is going to be 2x. So, it will be a line something like this. So, this is going to be my direct cost line DC. Now, in next step what I do? I add this IC as well as this DC. So, you will find that it will be having a shape like this. And this is nothing but my TC, total cost. So, what you can find here is that even if I am producing 0 unit, this is 0, 1, 2, 3, 4 and so on. Even if I am producing 0 unit, I am having some cost, and that cost is coming from the indirect cost component. And at 0 production level, I do not have any direct cost. So, these are the 3 lines I was talking about. Now, on this particular graph itself, I will try to plot a revenue line. Now, if you notice the revenue equation, it is given as R is equal to N times P, where P is your sales price. So, if I am not able to sell even a single product, my profit is going to be 0. If I am producing 1 and selling 1, my profit is going to be, revenue is going to be P. If I am selling 2 units, my revenue is going to be 2P. So, you will find that I get another line like this. and this is what I call it as revenue line R. Now, what is of interest to us here is this point and its corresponding value on x axis as well as on y axis. This is what I am calling it as B. That means this is the production level beyond which I have to produce and sell if I have to make profits. Below this production level B, I will be making losses. So, all this area you will find that will fall in losses, because n value here is less than B. But the moment I am exceeding B, I am making profit. So, all these areas are corresponding to my profit. So, here I write profit area and here I write loss. So, this type of break-even analysis is known as linear break-even analysis. Linear break-even analysis. Now, at the break-even point, there is no saving, there is no loss. More than B, we are making some profit. Below B, we are making losses. So, this point has been shown in this particular slide also. This is what has been shown. Now, we will try to utilize whatever formulas we have developed just now in order to solve a numerical problem. For this particular problem, please note it down. I am assuming that a ready mix concrete company sells RMC for a price of rupees 3,500 per cubic meter. Please note it down. The sales price is rupees 3,500 per cubic meter. That means we are given information on P. Now, the fixed cost of the company for the production are rupees 40,000 per month. So, this fixed cost has been estimated for a monthly basis, and they have found it to be rupees 40,000. The variable cost associated with per unit of production is rupees 1500 per cubic meter. That means my direct cost is rupees 1500. If I am producing 1 unit, I am incurring 1500. If I am producing 2 units, I am incurring 3000. If I am producing 3 units, I am incurring 4500. Now, in this particular problem, we are supposed to determine the break-even quantity. That means, how much should the company produce in order to break even? Break even means he should be able to just recover his total expenses. So, you can relook this problem like this. What should be the production level at which the company is just able to recover his expenses or their expenses? And that is why it is also known as cost volume profit analysis. We are concerned about the volume of concrete here, which must be produced so that the company is just able to recover his total expenditure. So, once you are clear of the concepts, the problem won't take much time to solve, and you will be quickly able to find out the value of break-even point. The break-even point would be given by total cost, you have to equate the total cost and the total revenue over a particular period, let us say 1 month. So, the total cost would be 40,000 plus 1500 x or 1500 n, whatever you say, and revenue is 3500 n. So, at break even you equate both these expressions. You will find the B value as how much? 20 cubic meter. That means, in order to recover all the costs that the company is incurring for a month, they should produce a minimum of 20 cubic meter. That means, if the company is producing less than 20, the company is sure to make losses. There is no point setting up the ready mix concrete plant if the company is not able to sell more than 20 cubic meter in a month. So, this is how we analyze such kind of results. So, as a manager you must always try to find how much billing I must do every month, so that I am able to break even, and you try to achieve more than that, so that you get decent profit. Then you must also think what item I should do in this particular month, so that my billing exceeds this value. Whether I should target concrete, whether I should target structural steel, whether I should target brick work or masonry work, or let us say structural glazing work, from where the money comes, so that I am able to at least recover my total expenditure that I am incurring every month. So, such type of analysis would be useful there. Or for that matter, if you are given some real estate business to handle, you will be told that you have to sell this many flats or these many apartments every month, otherwise we will be making losses. And that is how companies fix targets to their individual staff, to their individual people, because company may be knowing what is their indirect cost every month, not only at the regional level, branch level, they also know what is the expenses they incur at head office, home office. So, they are having very clear idea about the cost that they spend every month. They also know what is the total cost of producing 1 unit of apartment, including everything, land cost, cost of construction, cost of marketing, everything put together, they know it. Once they have got all this information, they can easily arrive at the number of units to be sold every month in order to break even, and more than that, then only they will start making profit. As long as they are producing or they are selling less than that particular break even value, they are running into losses. So, what is the managerial implication of such studies? Most of the companies you will try, they try to reduce this break even point. So, a less or the low level of break even point gives comfort level to the companies. Now, there are different ways through which they achieve this. Now, when I say lowering the break even point means, if you try to connect it to the RMC example, they will try to lower the break even point of 20 units to maybe 10 or maybe 5, maybe 15. The lower this particular B value, the higher the comfort level that company's executive get. So, one thing that you have to understand is I have to reduce this break-even point, number one. Then second thing that you have to concentrate is how to reduce this break-even point. There are many ways through which you can try to lower down the break-even point. For example, you can increase the sales price. That is one option and perhaps the easiest option, but you will find that there are problems associated with increasing the price also. Your demand may fall. So, that is the first option that companies have. The second way through which you can lower the break-even point is by reducing the total cost of production. Now, this is slightly difficult task. There are many ways through which companies try to reduce their total cost. They may have different avenues. For example, they can practice the concept of just in time. They may reduce the working capital. They may reduce their inventory. They may control the wastage. They may employ efficient methodology. They may employ efficient equipments. These are some of the ways through which companies try to reduce their costs. Sometimes they stop your perks. Depending on the market situation, they may even do that. So, this is second way of trying to lower your break-even point. And finally, the last one you can see, the third point, they can try to reduce the break-even point by increasing the production. What happens when you increase the production? You start increasing the efficiency of your plant or manufacturing unit. Suppose your factory has a capacity to produce 100 units and you have been producing only 60. So, you are not fully utilizing your plant capacity. So, companies try to find alternative market, different market, so that they can produce more and then they can sell it. We will discuss one more issue regarding this increase in quantity of production, that is also sometimes known as dumping. We will see just a while after this particular discussion, right. Now, so these are the three important ways through which companies try to lower the break-even point. Now, these measures, they can be adopted either individually, that is in isolation, or they can be applied in combination also. For example, in one case they may simply go and increase the prices. In another case, they may simply try to reduce the cost. In third option, they may simply try to increase the production. Whereas in most of the cases, you will find that all these things are taken up together. Maybe they will try to increase the prices by a small amount, they will reduce the cost by large amount, and they may also try to increase the production. That is why I said these measures can be taken up either in isolation or they can be taken up in combination. Now, this particular thing, utility of break-even analysis, we have already discussed these things are used mainly to analyze making versus buying decision situation, leasing versus purchasing decision. These are the two most commonly used applications of break-even analysis. Now, if you see make or buy decision situation, you may again get a chart like this. You may again get a chart like this. Now, how do you interpret this chart? If the break-even point, if the production is less than, let us say, Q dash, if you see this particular point, if the break-even is less than this, or rather production is less than this, buying is better. However, if you think that the quantity requirement would be more than this value, what do you find? Making is better. So, such kind of analysis also is possible using break-even analysis. Now, connected to this, I will give you a small problem again, in which you can note it down. Yes. Please note down this problem. It says consider a contractor who experiences a seasonal pattern of activity for compressors. The manager currently owns 8 compressors and suspects that this number will not be adequate to meet the demand. That means company right now possesses 8 compressors and they think that one more unit may be needed. The contractor realizes that there will arise situations when more than 8 compressors will be required, and that is why he is considering purchasing an additional compressor for use during heavy demand periods. So, basically the company is interested in evaluating the purchase of one additional compressor. Additional details are also available. For example, local equipment rental firm will rent compressors at a cost of $50 per day. That means, if you want to hire a compressor for a day, you pay $50 and get it. Whereas, you can buy the compressors for $6,000. If you want to buy a new set of compressor, it is costing you $6,000. The difference in operating and maintenance costs between owned and rented compressors is estimated to be $3,000 per year. That means, this $3,000 every year you have to spend if you are preferring to go for the purchase of compressor. Now, the problem is letting X denote the number of days a year that more than 8 compressors are required. Perform a break-even analysis. Assume a planning horizon of 5 years, 0 salvage value and 20% minimum attractive rate of return. So, what we have to do? We have to analyze a situation in which there are 2 alternatives: go for buying an additional compressor or else go for renting of the same. Now, depending on how many days you require the compressor, you can take the decision. So, basically this decision is getting influenced by the number of days you will require the additional compressor. So, basically I have to find B in number of days at which buying becomes better than renting and vice versa. So, can you do this problem? Technology class? Is the problem clear to you? Pardon me? Okay, please take it down. I will repeat it once again. Basically, a contractor wants to evaluate between buying and renting. The cost of purchasing a new piece of compressor is given and the information on renting is also given. Can you read this slide? Technology class? Okay, fine. So, I will send you through email. What I will do is, I will give you all these informations right here itself. So, it says a contractor wants to evaluate different options, especially of buying and renting. So, if the contractor purchases this equipment, he has to pay $6,000. In addition to this, he has to pay $3,000 every year for next 5 years. This is if the company prefers to purchase. Now, if you want to rent it, you have to pay $50 per day. So, suppose every year you are working for X days. So, your total cost would be 50x. Here also 50x. And finally, here also 50x. Now, you are given that MARR is 20%. Right? This is year 1, 2, 3, 4, 5. This is as far as renting is concerned. So, if you want to buy, you have to pay $6,000 at time t is equal to 0 and then every year $3,000 towards its operation and maintenance for next 5 years. There is no salvage value, while if you rent it, depending on how many days you are using, I have assumed X number of days. So, my cost every year would be 50x. Now, what I will do, I will equate the total cost for these two options. Now, here again I can perform the analysis either using present worth method or using annual cost method. Now, most of the times in break-even analysis, people prefer to use annual cost analysis. They find equivalent annual cost for both the options and then they proceed forward. So, here again what I will do is, I will try to get the equivalent annual cost for both the options. For example, for first option it would be EAC, that is equivalent annual cost. I call this as purchasing. So, P is going to be 6,000 A given P for 20% for a period of 5 years, and I will add 3,000. Now, remember these are all cost. So, I can as well use minus sign here, but just because we understand that this is cost and all data is related to cost only, even if I do not put negative sign, it is all right. But just understand that these are costs, and so our convention is to write with the negative sign. So, equivalent annual cost for purchase option is found to be this 6,000 multiplied by A given P for a 20% interest rate for a 5 years planning period, and in addition to this we have to add $3,000 also towards its operation and maintenance cost. Now, coming to this rent option, EAC of rent, I say R, it is given by simply 50x. Now, when I equate both of them, that means if I equate EAC of P is equal to EAC of R, what does this mean? We are trying to find that particular point at which I am becoming indecisive. I am neither in favor of purchase nor in favor of rent. I can choose anyone. Less than this value, I may choose this. More than that value, I may choose some other option. So, in order to find the break-even point, I equate the two costs, and it would be like this: 6,000 A given P for an interest rate of 20% for 5 years plus 3,000 is equivalent to 50x. So, this is nothing but 6,000 multiplied by some value plus 3,000 is equal to 50x. Do you have the table with you? How much is that?
So I got B equal to 100.. You want A by P?
Yes.
0.3344.
This value is 0.3344. That means the factor value for A given P at an interest rate of 20% for 5 years is 0.3344. So, this left hand side becomes how much? 5006.4, and this is equal to 50x. This implies my x is going to be 100.12 days. That means if I am trying to utilize this particular equipment for 100.12 days. Both the options are okay. I can go in for any one. But the moment x is less than this, the moment x is less than 100.12, what decision we have to take? Go for renting. If x is greater than 100.12, purchase. Is it clear, technology class?
Yeah.
Good. So, this is how we conduct linear break-even analysis. Now, I will also like to tell you the assumptions that we have made in this kind of analysis. If you note down this particular slide, it says assumption number 1, income is only from the productions under a study. What does this mean? In the previous example, wherein we had taken the case of ready-mix concrete manufacturer, we assumed that that particular company is only into production of concrete. So, all the money may be coming from sales of concrete alone. In real life situation, that may not hold good, because that company may be into some other business also. But in linear break-even analysis, we assume that income is only from the productions under a study. Another assumption that we made was whatever quantity is produced is sold out. That is why, if you remember, while deriving the formula, we had taken n value. N was the quantity produced and n itself was the quantity which was sold out. And finally, the last assumption, the per unit direct cost, indirect cost and sales price, they are constant throughout the production period, and these are also constant over the quantity produced, but it may not hold good in real life situation. For example, you might be finding that if you buy more goods from certain shopkeeper, they may offer you certain discount, right. Similarly, whatever quantity is being produced, all of them may not be sold out. There must be something in store also. So, these are some of the assumptions that were made to simplify our calculations. Now, we will try to deviate from these assumptions and then try to carry out the break-even analysis, but that aspect we will see it in next class. So, I conclude this lecture at this point itself, and when we come for next class, we will try to see different aspects of linear break-even analysis when there are more than one product involved with the company, right. That means multiple product break-even analysis. Then we will also see how companies try to increase their efficiency of plant and how do they sell their product. We will discuss the phenomenon of dumping, and we will see some more illustrations of non-linear break-even analysis. These will be the subject matter for next lecture. Yes, technology class, if you have any doubt, please. Thank you.